Hey, I'm Jeff Tan, and you're watching Taking Stock.
Well, we are counting down to the closing bell here at the New York Stock Exchange. Today is Friday, February 27th, and this is Taking Stock. I'm Remy Blair. We are seeing a sea of red on this Friday as we close out the month of February. Now, of course, all eyes have been on economic data as well as concerns about AI disruption. Also, jitters over private credit have been weighing on bank stocks in today's trading session. Of course, producer prices coming in much hotter than expected, and that did weigh on consumer sentiment. So, of course, we're seeing risk-off trading in today's trading session, and also concerns about AI disruption following NVIDIA earnings. And last but not least, we're seeing bank stocks getting hit hard on this Friday, and this does come amid jitters about private credit. And we are currently counting down to the close, and we are awaiting the sound of the closing bell. But before we get to that, of course, we'll be bringing you plenty in today's session, including the latest on the economic data and what it means for the Fed Reserve moving forward. Next week, we do get more earnings as well as the jobs report. But now it is time for the closing bell here at the New York Stock Exchange, and we're awaiting Quantum eMotion on the podium to celebrate its recent uplisting. Take a look at the podium as we close out the trading session. Well, that was the sound of the closing bell, and that means trading for today, the week, and February is now done. And of course, I do want to bring you the closing numbers here, starting out with the S&P 500. We are looking at that index settling lower, off by about 0.4%, and the Dow Jones Industrial Average settling down by triple digits, off a little over 1%. Meanwhile, as for the NYSE Composite, we are also seeing red as well, down by nearly 1.7%, while the Russell 2000 of small cap names, we are seeing that index lower as well, off by 1%. And joining us now is Matthew Tuttle, CEO of Tuttle Capital Management. Matthew, great to have you on. Thank you so much for joining us on this Friday. So we are seeing a sea of red, and this does come on the heels of concerns about AI disruption as well as the hotter than expected inflation figures. So what do you make of this price action?
Yeah, I'm not going to miss February. It's been crazy. It's been one of those months where, just looking at what the markets are doing does not tell you the story. Beneath the surface, you've got certain areas that are just getting crushed for a lot of the reasons that you mentioned. And then you've got areas that are rallying. A lot of times people like to say it's a stock picker's market. And when they do that, it's usually a cop out. But right now it isn't. If you're not in the right areas, you've been getting your head handed to you.
Yeah, and absolutely, because we've been hearing about momentum, rotation, as well as dispersion. But today we saw banks fall hard, and even the sector, financial sector, was the worst performing in the S&P 500. So what do you make of these private credit concerns?
So when you look at risk in markets, one of the things that concerns you is anything that can be systematic. And private credit is one of those things that if this gets worse, this can spread to a whole bunch of other areas. I have never been a fan of regional banks. We run SKRE, it's an inverse regional bank ETF. And, I think regional banks could get hit very hard. Never really been a big fan of the financials either, but it is definitely something you've got to be keeping an eye on because it's one of those systematic potential risks.
And Matthew, of course, all of us are paying attention to what's happening in the U.S. economy. We got those hotter than expected PPI figures. Is this a canary in the coal mine?
It could very well be, so everyone's all excited about the AI build, data centers, power, all of this stuff. Problem is it's inflationary. They're bidding up scarce resources that causes inflation. And higher inflation obviously is bad for a bunch of different reasons, but everyone thinks the Fed's going to be dovish. If we have higher than expected inflation, they can't, and that changes the entire narrative.
And Matt, one final question for you. Tell us about your concerns when it comes to AI disruption.
Well, I mean, AI is going to eat a lot of different areas. We saw it this past month: property and casualty brokers, financial firms, software, anything that's in danger of being crushed by AI, you want to stay away from. But a lot of times people throw everything out, and you can pick through some of that dislocation and find some nuggets. We like names like Snowflake and CrowdStrike that got crushed along with everything else.
Okay, Matthew, we will have to leave it there. So thank you so much for joining us on this Friday, and we appreciate all of your insights.
Thank you.
Well, as we close out the month of February, we're keeping a close eye on digital asset prices, in particular Bitcoin. Yesterday, I sat down with Federico Brocate to get his take on Bitcoin's recent pullback and what we can expect in crypto heading into the final month of Q1. Take a look. Well, joining me live this morning is Federico Brocate, Global Head of Business Development at 21 Shares. Federico, great to have you back. Thank you so much for joining me.
Thanks for having me, Remy. It's great to be here.
And when you think about the performance of Bitcoin in the past year and even year to date, we are looking at quite the shift. So you mentioned as point number 2 of your 3 points about how the structure has changed since last October. So for the layperson out there, what does that mean?
That means that people that were taking margin out to continue buying more and more Bitcoin were now forced to sell some of those positions down. And so that leverage that we saw in the market, which basically meant there was additional lending going on in the background of some of these purchases, is removed. And so as you sell down some of those positions, we see selling pressure forcing the prices going down.
Yeah, and we continue to hear about institutional adoption as well as the maturity of this market compared to past cycles. So what are you actually seeing?
Yeah, it's a great question. And actually, one of the things that I love talking about the most, because despite the price action, we've actually seen a lot of interest, especially from more professional investors over the last couple of months. When it comes to intermediaries, whether they're wealth platforms, the wirehouses, or RIAs across the country, a lot of them are looking at this price action as a good opportunity for their end clients to actually participate and come to the market for the first time. Just as recently as this week, we've seen over 2 billion in inflows into Bitcoin ETFs, despite trading around 65 million. Or 65,000. So certainly there's a lot of intent and appetite from the market. And I think there's a lot more capital that could come and benefit from this price moment.
And when it comes to the divergence in terms of trading between the institutional, professional, as well as retail investors, what's really happening? What is the data looking like right now?
Yeah, it's a great question. So ETF holders have predominantly held throughout the volatility. If you look at NNA across the Bitcoin ETF complex, we're around 53 billion in total assets since the launch of these products. That's about 85% of the all-time highs that we saw for NNA and ETFs. So really what that tells me is the majority of investors know that there's volatility when entering this asset class and are comfortable riding this cycle through the next, hopefully, uptick in prices. At the more retail side and the more crypto native side, we're actually seeing similar trends in on-chain data. And we're seeing more accounts that hold over $10,000 worth of Bitcoin popping up on-chain every single day. And so what that tells me is that there's a lot of conviction both in the crypto native side and the more retail trading side, as well as the more professional investors right now.
Yeah, and on this Thursday morning, a lot of eyes are on artificial intelligence, in particular earnings. And you mentioned some of the disruption and how that is affecting some key names in the tech sector. So how is that affecting crypto?
It's a great question. I think right now there's a view across investors that software companies that could potentially be disrupted by AI are unfavorable or they're out of favor. And if you think about Bitcoin and crypto more broadly, at the very, very core of it, it is a software. It is a few lines of code. And so I think it's getting looped into a lot of these conversations that we're having around companies like Microsoft and Amazon and what their moats are in a world where AI is so as powerful as we've seen these last couple of months.
Yeah, and before I let you go, we are fast approaching the opening bell. I do want to ask you about your recent launches in terms of products. So, what is the strategy here, and how does this fit into the overall outlook?
So yeah, look, we're really excited about expanding our U.S. product footprint in particular. We recently launched our SUI crypto ETF, as you mentioned, and it marks over 10 crypto ETFs that we have in the U.S. market today. And our product strategy has really diverged into the sense of the types of strategies that we're bringing to market. We have spot trackers like the SUI and the Bitcoin products. We have index products, levered, and soon to be an alpha strategy as well for the U.S. market.
And finally, before I let you go, one thing I do want to ask you about is the regulatory outlook, because here on Wall Street, we're paying attention to what comes out of the nation's capital. So, what do you expect and what's realistic?
Well, the first thing regarding regulation, I think it's continued to be supportive of our market broadly. If you look at the announcement from the SEC last week, they're basically classifying um, money market funds just like they are for the rest of crypto in terms of tokenized real world treasuries. And so what we've seen from Washington is continued support and more infrastructure around the asset class as a whole.
And regarding tokenization, that is a key theme that we're watching. So, when it comes to that innovation, both in the US as well as overseas, what can we expect?
Yeah, we've seen companies like Facebook announce already that stablecoins are going to be trading or available on Facebook, Instagram,
Yeah.
WhatsApp, which is incredible news. We've seen conversations led by Larry Fink and BlackRock around the opportunity to tokenize all real world assets, including most recently their entire ETF book, which would be really exciting to see on chain. So there's a lot of momentum. I think there's a lot of excitement around what tokenization could be, especially from an operational scale perspective. And we're excited to see how that disrupts financial markets globally.
Well, that is something we'll continue to monitor. So, thank you so much for joining us today, Federico, and thank you so much for your perspective. Thank you. And time now for fintech, crypto, and AI headlines. The crypto majors having a rough day today after the hot PPI print, with Bitcoin down almost 3%, ETH down 5%, and Solana down almost 5%. And next up, Anthropic says it will not lift restrictions on its Claude model for all lawful uses, as demanded by the Defense Department. Meanwhile, OpenAI CEO Sam Altman signaling that his company is ready to work on a deal that could bring its models into classified Pentagon settings with safety guardrails intact. And finally, fintech firm Block is laying off more than 4,000 employees, about 40% of its workforce, with CEO Jack Dorsey saying AI tools allow a significantly smaller team to do more as shares surged on the news. And joining us live here at the New York Stock Exchange this afternoon is Brian Hong, who is co-founder and CEO of Glider. Great to have you here. Thank you so much for joining us.
Thanks for having me.
Well, first and foremost, when it comes to permissionless utility, why are you in favor of open permissionless systems?
Look, when it comes to tokenized equities in this day and age, forget about Bitcoin, ETH, and Sol. We're actually seeing real stuff come on chain. So stocks, bonds, credit, mortgages, all of this stuff is much more interesting to investors because it's already investable, right? The power with permissionless systems means that you can actually do things with your assets that traditionally is taken away from you. If you get direct custody, you can lend your assets. You can cross margin across different products more easily and without middlemen taking fees all along the way.
Yeah, and you and I are here on the floor of the New York Stock Exchange, and exchanges are getting into the tokenization space, and institutional adoption has been the theme of 2026. So give us your take when it comes to risks for investors.
Yeah, we're really excited about this, right? It's finally the time where traditional finance is coming in and tokenizing things that actual people want. The problem with this is, how do you get access to these assets, right? All of us know that when you try to buy crypto these days, you have to deal with things like gas, signing, bridging, wallets. Like, some of this is vernacular that most of you just don't understand, or most people don't understand. And so part of what we do at Glider as well is make that easy for people to invest. And so as long as we see permissionless rails in the future, users will be able to invest without having to think about these complexities that currently plague crypto user experience.
Yeah, and we know that there's a lot of jargon there and a lot of vocab there that you have to learn. So what about liquidity and the discrepancies when it comes to liquidity?
Yeah, so not all on-chain stocks are created equal. One of our investors, Ondo, for example, pulls from traditional finance liquidity. If you wanted to rip, for example, $1 million of NVIDIA today on some of these on-chain wrappers, you would see spreads incredibly blow out.
Yeah.
And that's unacceptable, right? If we want to actually reinvent Wall Street on chain, we need liquidity to be there and accessible. Not only that, we need protections for consumers, right? In traditional finance, we have Reg NMS that allows you to ensure that you get best bid execution. We don't have that in crypto. And so lots of users these days are getting ripped off when it comes to very normal consumer protections.
And Brian, you mentioned wrappers. So one of the other things that I do want to ask you about is custom ETFs. So the question is how?
So Glider's the easiest way to make a custom ETF. Look, in this day and age, when you have an ETF, you're giving up utility to somebody else. For example, like there's Bitwise, there's all these ETF issuers that are charging exorbitant fees on these ETFs. And not only that, they give up the utility of those things that I mentioned before. So staking, lending, governance. We're in an era now where you can actually own your underlying assets and earn yield on top of them. And that's what's so cool about being on-chain, and something that we see growing in the future. So in our perspective, the wrapper is really dead. Same with stocks, right? Wouldn't you rather hold a direct index Mag 7 ETF than the actual stock itself? Because now you can lend those stocks, you can get the dividends, you can tax optimize. So direct indexing, specifically on chain, is really the future.
And Brian, finally, before I let you go, speaking of the future, there are a lot of innovations that we're watching, especially when it comes to this space. So what do you think this will look like for retail investors out there?
I mean, we're hoping to make this as simple as possible. You really shouldn't be able to tell the difference between investing in an on-chain asset compared to a traditional stock, right? When you think about interacting with Fidelity or Vanguard or any of your traditional brokerages, Robinhood, you don't think about the custodian, you don't think about the rails of how money gets there, right? That's the same experience we need to provide in crypto without you even having to know it's on crypto, right? And then we want to give you those superpowers. So those ability to lend, stake, govern, things that you can't do when you don't own your assets directly.
Well, Brian, it was great having you live here at the New York Stock Exchange. Thank you so much for joining us today.
Thanks for having me.
Well, that was Brian Hong, co-founder and CEO of Glider. Don't go anywhere. Much more Taking Stock after this quick break. Welcome back to Taking Stock. I'm joined by Dr. Francis Polito, CEO of Quantum eMotion. Dr. Francis, congratulations on ringing the closing bell, and thank you so much for joining us. Well, first and foremost, for our audience, tell us about the listing on the New York Stock Exchange.
The listing, we just started, it was a few days ago, started on Tuesday. And obviously you're a little bit overwhelmed, by the experience, and it's fantastic. We come here, in fact, because from Canada we were listed into TSX Venture, And I think it's such an achievement for a Canadian company to be traded in the New York Stock Exchange. And I think with that, we're going to widen, our reach, capital markets or different probably shareholders. So that's a real milestone for a company because we're at the very beginning of our growth. So I think we'll have all the tools necessary to make this company probably a giant in the space of cybersecurity.
Yes, and I can imagine this is a big day for you and your team. So I do
Absolutely.
want to ask you a little bit about the technology QRNG. Can you simplify this for us?
QRNG means a quantum random number generator. We're using quantum physics, where it's a little bit complicated, but what's important is the quantum physics is the only source of pure randomness. So what we do is that randomness, we are actually created architectures that become unpredictable. So that means that the hackers have extremely difficulty or impossibility actually to hack defenses that are built with the quantum, I would say, mechanics.
Yeah, and speaking of which, cybersecurity is a big issue. So when it
It's
comes
a
to
big issue.
Yeah, so
Yes.
when it comes to quantum, tell us about the reality on the ground.
The reality is that we've seen in the past 2 years a huge acceleration, that quantum computers will be a revolution and for in many fields. It's going to revolutionize humankind in many, because the sheer power of these quantum computers, will basically open new adventures and new discoveries that we not even have idea today. And the problem is that in good hands, it's all positive.
Yeah.
But in the bad hands, these computers can also be used to crack all our defense. And a quantum computer, if we don't change, in fact, the way we build right now our defenses, we could have an apocalypse because the quantum computers will be able to crack and destroy almost any key, any encryption. For example, Bitcoin, would be extremely vulnerable to attacks of quantum computers, but all the financial system, but everybody.
Yeah, and I'm glad you brought that up because there have been headlines out there
Yes.
regarding quantum and crypto and the worries out there. So
Yes.
finally, before I let you go, what is the roadmap for quantum emotion?
Well, the quantum remotion now our technology is mature enough. In fact, we started commercialization just the last quarter. So now we had one of the first, if not the first, quantum communication company that actually able to deploy our technology now in the markets commercialization. And I think that you're going to see is that the appetite, because security matters it matters for everybody. So you're going to see a huge appetite actually to be better protected against these attacks or the possibility of attacks. Because you cannot wait till quantum computers will be available. You have to prevent, and basically strategically already be prepared for this attack. If you wait the moment where they appear, it will be too late.
Yeah, there is a reason why they say hindsight is 2020. So
Absolutely.
thank you so much, Dr. Francis, for
A
joining
pleasure.
us today, and congratulations on the closing bell.
Thank you. A
Thank
pleasure.
you very much.
Thank you.
And that was Dr. Francis Bolito here at the New York Stock Exchange. And after the break, the latest from Money 2020's Chief Strategy Officer, Scarlett Sieber. Don't go anywhere. We'll be right back. Welcome back to Taking Stock. Today in startups raises and rounds. First, OpenAI is raising $110 billion in one of the largest private funding rounds ever. SoftBank, Nvidia, and Amazon each committing tens of billions of dollars, valuing the ChatGPT maker at $840 billion ahead of a potential mega IPO. And next up, Netflix has backed out of its $83 billion bid for Warner Brothers Discovery and declining to match a higher $111 billion offer from David Ellison's Paramount Skydance, this clearing the path for a potential Ellison takeover of the Hollywood giant. And finally, Jeff Bezos' AI venture project, Prometheus, is in early talks to raise tens of billions for a new holding company that would invest in businesses transformed by its technology, and sovereign wealth funds as well as JP Morgan among those set to be in discussions. And now Money 2020's Scarlett Sieber is back with Jargon Translator, putting fintech terminology into language anyone can understand. Take a look.
Welcome back. I am Scarlett Sieber for Money 2020, and on this segment of Jargon Translator, we're going to make sense of terms that sound random, but they hit your wallet hard. Today's term, gas fees. Here's the deal. Gas fees are the transaction costs you pay to use a blockchain like Ethereum. Think of them like tolls on a highway. Every time you send crypto, buy an NFT, or interact with a smart contract, you pay a fee to keep the network running. But what's actually happening underneath the hood? Every transaction on Ethereum requires computational power. Miners, or validators in proof of stake, process your transaction and secure the network. Gas fees are basically the tip you pay to get your transaction prioritized. The more complex the transaction, the more gas it burns. A simple transfer? Cheap. Deploying a smart contract? That's like ordering champagne service at a dive bar. That is gonna be pricey. So why are these gas fees so expensive? Because when traffic spikes, gas fees skyrocket. It's supply and demand at the simplest. More people using the network means higher costs. During NFT drops of meme or coin frenzies, gas fees can jump from a few bucks to hundreds of dollars. Here's the kicker. Gas fees aren't fixed. They fluctuate based on network congestion and the gas limit that you set. If you set it too low, your transaction might fail, but you still pay for the attempt anyways. That is brutal. Next time you're wondering why your $20 NFT cost $80 to mint, blame gas fees. They're the price of playing in the decentralized world. Until scaling solutions like Layer 2 or Ethereum upgrades fully kick in, gas fees are here to remind you decentralization isn't cheap, but it's part of the game. Gas fees, the ultimate reminder that even in crypto, freedom isn't exactly free. And with that, that is your jargon translated. Until next time.
Well, we are officially wrapped up for February trade. We saw the major U.S. stock averages close in negative territory, with the Dow Jones Industrial Average off by triple digits, closing lower by more than 1%. We also saw the S&P 500 off by about half a percentage point, and of course concerns about AI disruption, as well as hotter than expected inflation weighing on the markets. We also saw that private sector credit woes weighing on bank stocks. And of course, as we head into the weekend, we will be paying attention to upcoming economic data in the week, including the jobs report. And that does wrap it up for Taking Stock live from the New York Stock Exchange. Have a great weekend.